Hey everyone, welcome to today's The Steady Trader video. Welcome back from a long weekend for those of you that celebrated the Memorial Day weekend. Well, we're back and markets are all over the place, mostly lower in terms of stock prices. It's a real risk-off morning so far today as I'm recording this on the Tuesday, May 29th. And I wanted to go through a couple of things and we just actually got off a coaching call with some of our coaching clients and went through a couple of scenarios here because Italy here is having some re-election issues. Once again, they seem to have that all the time. It's actually not a laughing matter, but it's almost a little bit, I guess, ironic. Either way, it's what's happening and it's what we have to deal with. So essentially what's happening is that there's governments infighting, all that kind of stuff happening in Italy, and they're basically threatening the sort of it's anti-establishment parties are trying to basically pull Italy out of the euro. We've seen this before, and I'll go through a series of charts for you guys right now to see what this means and what this could mean for markets here going forward. But it is serious, I think. And so, anytime you see a major country, part of the euro, wants to pulling out of that country, out of the union, that is an issue, right? Even if it's only temporarily so. So what we need to do now is put our macro or global hat on. And, I talked to a lot of people that tell me, oh, I don't think this macro stuff, or I didn't think this macro stuff is important. It is important, okay? When it comes to these kind of things, where like right now what's happening today, and we've seen this throughout the past 8 years on and off, where Europe will kind of lead U.S. markets, not for a long time, but usually for a 2, 3, 4 month period. And I think we may be getting back into one of these periods right now. And that's why it's important to actually understand and look at a few charts. We're going to keep it very simple, I promise you. But there are a few things we need to look at. So stay with me. Let's look at some charts. Okay. So let me flip this camera. Here we go. So what this is this is a chart of the Bund futures contract, which is the European, I guess, like the benchmark sort of bond yield. Or bond price, and you can see what's happening here this morning. This is a long-term, multi-year chart. You can see that rally today. That's right here, right? That is, obviously bonds going higher, bond yields going lower in Europe. So people are, buying protection, if you will, fleeing out of equities. So if you want to put a quick technical analysis on this, you could see it doesn't take a genius to see this, but there technically is a bull flag pattern. I don't know if we're going to break out the upside, but I'm telling you that is what's going on. Now, before we look at equities, have a look at a couple things. Number one, interesting thing to watch and an important thing to watch is the euro. The euro has been under pressure now for some time. This is nothing new. The euro is getting back to levels where it recently broke out from recently in 2007. So this, for all intents and purposes is not unimportant. We'll see if this can hold, but the euro is, in my opinion, very likely to remain very choppy. Are there going to be opportunities to buy for a bounce? Yes, I do think there will be, but I think the overarching argument here is that we're going to continue to see bounces. I would not be surprised if we see ultimately some sort of a bounce here in the euro to a lower high. Ultimately, we'll have a head and shoulders pattern, and then the euro would be dropping. And all this, of course, means that the U.S. dollar index that I always talk about, let me quickly flip the camera. The U.S. dollar index, this arguably will mean that the U.S. dollar index will continue to get stronger. If the U.S. dollar gets stronger, okay, ultimately that causes a lot of problems in the world of risk assets, not just in the currencies here, of course, but also, for example, emerging market equities, and ultimately also U.S. equities. Okay, so let's keep that in mind. It's not that a strong dollar is bad. It's just at this point in the economic cycle that can be a headwind. So let's flip the camera around and look at a few things. Let's look at the Italian stock market. Okay, and if you're getting bored and sort of saying, "Oh, surge doesn't matter," just stay tuned for a minute. This does matter. Okay, the European stock market. I'm trying to give you some perspective where these things are. So this is the Italian stock market. Okay, we are back at levels where we last were in about roughly the midway point of 2017. So the Italian stock market obviously today down strongly 3.5% so far on the day, but we are back at where we were in about the midpoint of 2017, which was here. So we've basically done nothing. I mean, well, there's been plenty of upside movement. You can see we're stalling. So going over to a arguably, I hate to sound like it's maybe a more important European stock index, and that is, of course, Germany. And so I don't say more important in a derogatory way towards others, but maybe one that more people watch, right? Not everyone watches Italy, not everyone watches Spain, everyone watches the DAX, for better or for worse. And you can see what's going on here, even though everything is remaining quite nicely trending to the upside. We are here too threatening a potential lower high. This is something we've been talking about now to clients for some time. You can see this lower high potentially being developed here. And if we do get a lower high, then ultimately, of course, the path of least resistance would be at least sideways, arguably lower for some time. And again, most importantly, stocks will likely then continue to chop sideways. Lastly, we can look at the U.S. markets, and I'm going to quickly pull up this ticker here, which is, let me see, U.S. 500, which is essentially the futures, the S&P 500 futures contract. And you can see here too, we are threatening potentially making a lower high. Again, it has not yet completed, of course, but here too, we are potentially looking at a lower high. So all of this said, again, I don't think this is a time to freak out. It never is a time to freak out. That's my main motto here. But it is important to keep in mind that I think as we're getting into the summer period here, we've seen this story develop over the years. If you've been in the market for more than a couple of years, you've seen this happening over the past 5, 6, 7, 8 years. Every summer, or not every summer, but every other summer or so, we've had some sort of European crises in some shape or another. And it ultimately does go, or in the past has gone away, but it kind of keeps coming back. And so this is the latest version of this. Ultimately, what it means is, to me, more volatility. And more importantly, or maybe most importantly from a trading perspective, it does mean that European stocks could be leading indicators for U.S. equity volatility on a day-over-day basis. And that's really what we're going to be looking for. That's the opportunities that we're looking at. And that's actually one of a trade that I'm going to be sharing with our Clubhouse members and our Trade Alert Service members a little bit later on today as well. So I hope this is helpful, folks. Have a wonderful day. Any questions, as always, comments down below. I'll see you guys tomorrow. Thank you.